Basically, today we are going to start the revision for financial reporting based on our study plan. And as we all are aware, the examination is just around the corner, barely 4 weeks, effectively. So I thought it fit that we need to start doing detailed revision on the syllabus. So we are going to start looking at key syllabus areas, and also we are going to solve past questions from the kits, and if possible, we are going to look at questions from the CBE practice platform. So basically, today's session we are going to focus on key accounting standard. Almami, please
Yeah.
mute your mic. Thank you very much. So as I was saying, we are going to focus on key accounting standard IAS16, IAS40, and IAS20. We are going to solve past questions on these three areas, and also I'm going to give a brief background, a knowledge recap on the various accounting standard I mentioned. So basically, without wasting time, we are going to start effectively, and the session can last for minimum 2 hours, depending on your time and I don't know your schedule. But for me, I'm free, and really, I want everyone to give the necessary time because we have limited time for the examination, and it's very key. I want to keep maintaining the pass mark for my students. And for the December 2020 five examination, 5 students attempted the financial reporting, and 4 of them obtained pass on first attempt, which is a very good outcome. And also my student for the audit and assurance, 5 of them attempted audit and assurance, 3 of them obtained pass mark on their first attempt. So basically, we just need to keep focus and ensure we give the necessary time and focus on our various studies. So now I'm going to share my screen. We are going to start looking at IAS 16, just to recap on the concept and key principle that you need to know. Also, we are going to look at IAS 20 and we are going to look at IAS 40. Then thereafter, we are going to look at the kits. Then we can tell best we can solve questions as best as possible. Looking at section A, the multiple choice questions, and section B, the scenario-based multiple choice questions. So this is the approach that we are going to use to conduct the revision session. So basically, when we are talking about IAS 16, we're talking about the property, plant, and equipment. And are you seeing my screen right? Hello, guys. Hope you are seeing my
Yeah.
screen. Very good.
Yeah.
So basically, this
Yeah.
is
Good stuff.
okay. So this is my lecture notes, and also in addition, I'm expecting everyone to have gone through the recording session for property, plant, and equipment, IAS 40 and IAS 20. I've already completed the recorded session. You can access it on my YouTube channel as well as my TikTok account. So today I'm just going to browse on key concepts and principles. Thereafter, we can solve past questions. So basically, when we are talking about IAS 16, which is property, plant, and equipment, we are going to look at the tangible assets held by an entity for more than one accounting period, which is very much important. So if we want to understand the definition of IAS 16, the property, plant, and equipment, we need to go back to the definition according to the conceptual framework for assets. Very important concept. Then thereafter, we are going to cover the scope of IAS 16, which has to do with the tangible assets for a period more than 1 year. Then also IAS 16 did not cover the biological assets, as we are going to cover it under IAS 41. And also it's devolved from the investment property as well as the non-current assets held for sale and discontinued operation, which is the IFRS 5. So basically, we are going to look at the recognition criteria. As per the conceptual framework, after the definition of an element of the financial statement is met, the key important area is the recognition criteria. So what do we mean by recognition criteria? It means that if we want to include an element within the financial statement. For example, an asset. If we want to include an asset in the financial statement, the recognition criteria should be met. So according to the recognition criteria for property, plant, and equipment, first condition, it is probable that the future economic benefits associated with the asset will flow to the entity, which is very clear. The second condition is the cost of the asset can be measured reliably. So for us to account, for us to include a transaction as an property, plant, and equipment in the financial statement, the recognition criteria should be met. Thereafter, we are going to look at initial recognition, initial measurement. And when we are talking about initial measurement, it means at the contract inception, how are we going to calculate the total cost of the the assets? So we are going to look at the purchase cost, and we are going to look at all direct related costs and bringing the asset into its present condition in a workable situation, the site preparation, the delivery cost, the installation cost. Also, we are going to look at the components of borrowing costs that we are going to capitalize as part of the initial measurements of the property, plant, and equipment. Very important concept you need to know, because when we are going to look at the past questions, these areas will be tested in the examination. The site preparation cost will be given to us, the delivery cost, installation costs, also training, warrants, other exceptional costs will be included. And you will be tested to segregate between the cost that should be included as part of the initial measurement, as well as the cost that should not be part of the initial measurement. So very important concept. Then also the cost that we need to include as part of the initial measurement is the dismantle cost. And this is a key concept that you need to know for the examination, because understanding the dismantle cost will help you to understand IAS37 provisions, contingent asset, and contingent liability. Because if we are talking about the dismantle cost, this is a future cost that the business is expected to incur in the next 10 years. For example, let's assume we install a plant within the community, and based on the agreement with the community, we unanimously agreed that at the end of the useful life of the plant, you need to restore back the property that belongs to the community. So if that is the agreement between the company and that of the community, then at the end of the life of the plant, you need to remove that plant from the community. You need to dismantle that plant. So according to accounting, you need to ensure that you make a provision, because the cost will be incurred in 10 years' time. But now you need to account for the cost in year one. Thereafter, we are going to unwind the cost to the end of the 10 years. So basically, this is the concept. Already covered it detailed in my recording session. So if you want to, have a detailed understanding, you can go through my recording session. I've already solved past questions on that dismantle cost as well. So basically, this is just an example on how we can calculate the dismantle cost, the amount that we are going to debit as part of the cost of the asset, and the amount that we are going to credit as a liability. Then also we are going to look at the unwinding element that we are going to show on annual basis as an expenses, and also we are going to increase the liability. So at the end of the year, at the end of the 10-year, the liability will equals to the future value. So basically, I'm going to you need to go back to my recording session so you can be on track. Thereafter, we are going to look at subsequent expenditure. So when we are talking about subsequent expenditure, it means um, after the initial recognition, the second year, how are we going to calculate the value of the property, plant, and equipment? Also, we are going to look at if there is a major restructuring of the premises, of the property, of the equipment, or if there is a replacement of major components or parts of a machine. Therefore, we need to know whether we are going to capitalize that particular cost or whether we are going to expense that particular cost. So basically, the key concepts about subsequent capital expenditure, because we have two types of expenditure. We have the
Mr. Sise,
capital. Yes, sir.
sorry for the interruption. If you can expand your if you can expand your screen, it will be fine for us a little.
Okay. So it's
Yeah, the
so
screen
what about this one?
presentation. It's for my end, it's small a little.
You can zoom the screen for yourself. When you zoom it, you will see it clearly.
Okay, okay. Full
Yeah,
screen.
yeah, because if I try to zoom the screen, the other portion of the screen, I'm not going to see. So
Hello?
if you can zoom it on your own, then it's fine.
Okay, okay. I will tell that. Okay, sir.
Okay.
Sorry, sir.
No, it's fine. It's
Thank.
fine. It's fine. It's important
Yes.
that you. Sorry, let me add this newcomer.
Okay.
So So basically, as I was saying, we are going to look at the subsequent expenditure. Basically, the concept about capital and revenue expenditure is simple. Now, when we are talking about capital expenditure, we can classify an expenditure to be capital in nature if that expenditure will enhance or will increase the economic benefits of the assets. Automatically, if that condition is met, then we are going to um, capitalize that particular expenditure as part of the cost of the asset. You see, for instance, we can agree. So now, um, this is what you need to know about the capital expenditure. And for revenue expenditure, for example, basic um, refurbishment or painting of the property, for example, we don't need to capitalize that particular expenditure. We need to expense it directly on the profit and loss account. So this is the subsequent measurement, which is the capital expenditure. You can go through my recording session. You will have the full understanding. So basically, also we have subsequent measurement according to IAS16. After we have completed the initial recognition, we have the option to either value the asset at cost or we carry the asset at revaluation model. So now for initial measurement, it is compulsory that we use the cost model to value all property, plant, and equipment according to IAS16. And when we are talking about the cost model, it means the total cost of the asset, looking at the purchase price, looking at the installation cost, looking at the cost of transportation, looking at the cost of bringing the asset to its present condition, looking at the cost to ensure the asset is fit for its intended purpose. All of these costs should be included as part of the cost of the asset for initial recognition. Thereafter, at the end of the accounting period, we are going to depreciate that asset. We are going to reduce the value of the assets on annual basis. Thereafter, we are also going to do some impairment test according to IAS 36. We are going to do some impairment tests to ensure that if there's any indicator of impairment, if the asset value has fallen, we need to account for that particular reduction in value. So depreciation and impairment, they are not the same. They are two different concepts, but basically they they are all a reducing factor from the cost of the assets. Sorry, let me add this new guys. Sorry, please. So basically, for the subsequent measurements, we have the option according to IAS16 either to carry the asset at cost model or we are going to use the revaluation model, either of the two. So basically, um, for the revaluation model, we are going to revalue the assets at each year end. Also, we are going to calculate depreciation on the revalued amount. Then also, if there is a gain or loss on revaluation, we are going to account for it. If there is a gain on revaluation, we are going to account for it under the revaluation reserve. And if there is a loss on revaluation, we need to look at how we can account for it, depending to whether the asset has been previously revalued or not. There's key concept about that. But in other words, if we are going to look at the evaluation model, it's simple. We need to know exactly what to do. So basically, you can go through my recording session to have a complete explanation. This is a revision session, so I'm just going to browse on key concepts. I'm not going to, to illustrate in depth about the accounting standard. I'm just going to touch the key areas. So basically, when we're talking about depreciation, this is a system or method that we use to allocate the cost of the asset over its useful life. This is depreciation. For example, if the useful life of the asset is 10 years and the cost is 10 million, for example, it's just an accounting calculation. That's why when we are going to look at taxation, the depreciation, we are not going to include this as part of the tax adjusted trading profit because it is non-cash item. It's just an anticipation, an accounting treatment to ensure that we offset the cost of the asset annually over the useful life of the asset. So under the depreciation, we have basically two major methods. We have the straight line method, which means we are going to calculate depreciation on annual basis, and thereafter we are going to spread that depreciation until the useful life of the asset. For example, if the asset useful life is 10 years and the cost of the asset is 10 million, it means on annual basis we are going to allocate an expense of 1,000 to the depreciation, to the profit or loss account. That's what we refer to as the straight lines. So that particular depreciation, we are going to spread it out throughout the useful life of the asset. And also, if we're talking about reducing balance method, it means when we have calculated the depreciation for year one, we need to deduct the year one depreciation when we are about to calculate the year two depreciation. So we are going to reduce the impact of year one depreciation from the calculation of year two depreciation. That's what it means by the reducing balance method. Also, we are going to look at in a situation where there's a change in from one method of providing depreciation to another. For example, if this specific asset we have been using the straight line, we decided to change to evaluation method. How are we going to account for the excess depreciation? And also, when we are going to look at IAS8, we need to know whether this is a change in accounting policy or whether this is a change in estimate. Very important concept you need to know, and this area will be tested in the examination with regards to whether you need to classify a specific transaction as a change in accounting policy or whether it is a change in estimate. So basically, this is the key concept you need to know for the property, plant, and equipment. So now let's just browse through the evaluation of non-current assets. So now, according to IAS16, we have the option to carry the asset at either evaluation or at cost model. So if we are going to carry the asset at cost model, it's simple. The cost of the assets less the accumulated depreciation less any impairment. Then if you are going to carry the asset at evaluation model, which is the property, plant, and equipment should be carried at evaluation model, less any subsequent accumulated depreciation. So now the key concept that you need to know, once the asset has been revalued, so when we are going to calculate any depreciation, we are going to calculate it on the revalued amount. Because if the asset value, for example, in year one is 10,000, then we decided to revalue the asset based on the revaluer. The asset value has increased from 10,000 to 14,000 units. Automatically, the 3,000 gain on evaluation, we are going to debit it and the asset account, and also we are going to show it as other comprehensive income under the OCI. Automatically, the increase in the fair value as shown in the statement of financial position as well as the statement of profit or loss. So now when you are going to calculate depreciation on annual basis, you are going to calculate depreciation on the revalued amount, not the historic cost anymore. So you're going to calculate depreciation on the 13,000, which is the revalued amount. So basically, what you need to know, you can account for the evaluation gain as well as the evaluation loss. Very important concept you need to know. So evaluation gains are recorded as a component of other comprehensive income. Evaluation loss, which is representing an impairment of an asset, are recognized in the statement of profit or loss. So I'm expecting you as a student to start thinking why the gain on evaluation is recorded in other comprehensive income and why the loss on evaluation is recorded in the statement of profit and loss, because the statement of profit and loss according to IAS1 and the statement of other comprehensive income, they are not the same. Both figures will be shown in the statement of profit or loss, but will be shown separately. After the profits, the retained earning, we are going to show other comprehensive income underneath the profits for the period. So now, if you want to know the reason, I'm going to refer you to the prudence concept, which stated that in the event of gain, we should not recognize gain until it is actually realized. That's what the prudence concept is saying. Then for loss, we can account for loss when it is anticipated. then we can account for that particular loss. For example, the impairment, we are going to account for it in the statement of profit and loss directly. Whilst the gain on evaluation is shown in the other comprehensive income. So basically, this is how we are going to account for gain or loss on evaluation. Very important concept you need to know, and it is important because mostly this concept will be tested. Now, how we can depreciate revalued assets? The valued asset can be depreciated based on the valued cost. Thereafter, it is very important concept again you need to know in the event the asset has been previously impaired or a valued asset is now impaired. How are we going to account for the difference between what amount that is seated in the evaluation reserve and the impairment? So an annual reserve transfer may be made from revaluation surplus to retained earning for the additional depreciation charge on the revalued amount compared to the cost. Also, we are going to look at the aspect when there will be an excess depreciation. How are we going to account for the excess depreciation? So now, the journal, we are going to debit the statement of profit or loss for the depreciation charge. Then we are going to create accumulated depreciation. Plus, we are going to debit the evaluation reserve, the surplus, then the retained earning. If you want to understand detail about this accounting treatment as well as the example, you can go through my recording session. All of these examples, the solutions are there, so you can have an in-depth knowledge. Then thereafter, our final session for IAS16, we are going to look at the derecognition of asset, the disposal, sorry. So when we are talking about disposal, it means when we want to sell that particular asset, automatically, according to the conceptual framework, we are going to derecognize the asset from the statement of financial position. Then also we are going to recognize a gain or loss on disposal, which we are going to compare the cash that we receive, the proceeds, as that of the carrying value of the assets. Then the difference between the proceeds and the carrying value will determine whether there is a gain or loss on evaluation. And we are going to account for it under the profit and loss. So basically, this is all what we need to know about IAS16, which is property, plant, and equipment. So we are going to look at IAS20. We are going to look at government grants. Thereafter, we are going to look at IAS40, and we can start solving questions because it's very important to solve past questions so that we can have the actual feeling in the examination. So when we are talking about IAS20, the accounting for government grants and disclosure of government assistance.
Sorry for interrupting, sir.
Okay.
Yeah, I think someone wants to say something or maybe ask a question. He has been raising his hand.
Okay. Sorry. Yes.
Yeah, it was me, Mohammed. So, when we do depreciation change in method, we only do a prospective change, isn't it? It's not a retrospective change, yeah? So you only
Exactly.
change it. Yeah, okay.
Yes. That's
Yeah,
why
okay.
we need to understand the difference between the change in accounting policy and the change in estimate, because change in depreciation method is a change in estimate, which means we are going to account for it prospectively, not retrospectively. We are not going backward. We are not going to adjust the previous year closing balances. No, we are just going to treat it on the current accounting period going forward.
Okay, thank you.
You're welcome. Any other question before proceeding? On IAS16, I want to jump to IAS20, and we are going to cover IAS40. For the newcomers, basically, this is a revision session for the financial reporting students who want to attempt the March 2026 examination. So basically, the syllabus is already completed. We are just going to look at key areas within the syllabus because it remains 4 effective weeks for the examination. So today we are going to cover IAS 16, IAS 20, and IAS 40. Also, we are going to solve past questions 5, 10 from each accounting standard so that we can have the actual taste of the examination. So that's what the session is all about. So any question for IAS16? I want to move further because we have limited time. Any question? Any question for IAS16 or let me proceed?
Let's proceed, sir.
You can continue.
So now
You can
we are going
continue. Yeah.
to look at government grant and disclosure of government assistance. So when we are talking about government grant, basically the definition is not much important for financial reporting level, but you just need to know what is government grant. It's basically the transfer of resources, whether it's cash or otherwise, in kind or in the provision of service, or the provision of technical expertise by the government to the company, whichever form, we can refer to that particular situation as government grant because it is a transfer of resources. The company will receive economic benefit as a result of the transfer of resources from the government assistance, or from the government body to that particular company. So that's basically the definition of government grants as well as government assistance. So now, basically, these are just few reasons why government gives grants to company. We can say it for promote business expansion. It's very clear that if the business is undergoing some financial challenges, the government has the right and responsibility to step in to provide some financial support, to provide some technical expertise, to provide some to give some tax concession, whichever it might be. It's part of the government responsibility to support business to ensure the business going concern is defined. Also, another help the government provides to support employment creation, because if there's a if the company continue to operate, then automatically there will be an employment for the citizens of that country. Another reason to promote regional or rural development, which is very important. So basically, these are just few reasons you need to know. And then let me proceed further. So now the key concept IAS20 follows two general principles when determining the treatment of grants. Very important concept you need to know. The prudence concept. Grant should not be recognized until the conditions for receipt have been complied with and there is a reasonable assurance that the grant will be received. Very important concept you need to know. If you don't understand anything about government grant, you need to know this. We can only recognize a government grant under the two conditions. Firstly, the condition attached to the government grant should be met. Now, what did I mean by condition is that, for example, if the government gives the grant for the purpose of employment, say, for example, you need to employ additional 50 Sierra Leoneans, then I will give you $4 million, for example, to support your business. So this is the condition that you need to meet so that the grant need to be recognized in the financial statement. That's the first condition. Every condition attached to the government grant should be met before we are going to consider whether we should recognize the grant or not. Second condition, we need to have a reasonable assurance, greater than 50% chance that we are going to receive the grant, the cash or the services or whichever grant from the government. We need to have greater than 50% assurance that we are going to receive that particular grant. So if these two conditions, according to the prudence concept, are met, then we need to recognize, we need to include that particular transaction in the financial statement as government grant. But if either of the condition is not met, then we are not going to recognize that particular transaction in the financial statement as government grant. Very important concept you need to know for IAS 20. Also, we are going to look at the accrual concept. Grants should be matched with the expenditure towards which they are intended to contribute. Very important concept. So we are going to look at the definition. You can read it for yourself. Definition of government grant, government assistance, grants related to income, grants related to expense and to assets. Now let's look at the grants related to income and assets. Very important concept because when we are going to account for the grant, we can either use the income approach, and we can use the asset approach, which can be the deferred income approach, or we can use the matching concept. So basically, if we are talking about grants related to income, grants intended to compensate for expenses or losses already incurred or for immediate financial support. You need to note it down. Grant intended to compensate for expenses or losses already incurred. Already incurred. Very important concept, very important point. For expenses already incurred or for immediate financial support. I'm going to give it color. You need to classify that particular grant as income, grant related to income. So if we're talking about grant related to assets, grants whose primary condition is that the entity must purchase, construct, or otherwise acquire the long-term asset. So any grant that is given to purchase, to construct road, to construct, a capital development project, or to acquire a long-term asset, these type of grants should be classified as grants related to asset. So you need to know the distinction between grants related to income and grant related to asset. For grant related to income, it's expenses or losses already incurred, or for immediate financial support. It should not be for purchase, it should not be for construction, it should not be for any acquisition of long-term capital assets. So now we are going to look at the recognition criteria. A government grant should not be recognized until there is a reasonable assurance that the entity will comply with the conditions attached to the grant. I've already mentioned that. Also, the grant will be received. There should be a reasonable assurance that we are going to receive. The company is going to receive the grant from the government. Note, reasonable assurance, same concept as probable, greater than 50% chance that we are going to receive that particular fund from the government. Grants are recognized in profit or loss on a systematic basis over the period in which the entity recognize and expense the related costs for which the grants are intended to compensate. So now we are going to look at the accounting for government grants as per IAS20. We have the revenue approach and we have the capital approach to government grants. Very important concept you need to keep in mind. So now we are going to look at the revenue approach. The revenue approach of government grant will depend on the circumstance. If the grant is paid when evidence is produced that certain expenditure has been incurred, the grant should be matched with that particular expenditure. If the grant is paid on a different basis, for example, achievement of non-financial objectives such as the creation of a specific number of jobs, as I mentioned earlier, the grant should be matched with the identifiable cost of achieving that particular objective. So basically, what the revenue approach is telling us that we need to match the grant against the expenditure, it is whether it's an expenditure related to the provision of non-financial objective, whichever situation it might be, we are going to match the cost against the grant that we are going to receive. For example, the non-financial objective set by the company, is to, let's say to improve or to seek new jobs, for example. Now, the cost relating to that new job that will be offset against the government grant that is received for that particular new job creations. So we are going to match it. That's what the revenue approach is telling us. So now, how are we going to present the revenue grant? IAS20 allows short grant to either be presented as a credit in the statement of profit or loss. Very good. We can show it as grant, government grant income. First presentational criteria according to IAS20. We can show it as government grant income in the statement of profit or loss, or deduct from the related expenses. Simple. For grant related, for revenue grant, these are the two options that we need to exercise. You can use either of the option, it's fine. It is not against the fundamental principle of IAS20. So you can either use the government grant income or you deduct it from the related expenses. Either option did not contravene the IAS20. So now the key concepts, which is the capital grant. IAS20 permits two treatments for capital grants. Write-off grants against the cost of the non-current assets. For example, if the grant is to purchase a non-current asset, let's say a generator, if the grant is given to purchase a generator, therefore, we are going to match the grant against the non-current assets, depreciated the reduced cost. Now, for example, the government wants to support a particular community, that they did not have a electricity facility. So the government want to support the community by providing government grants to the community, for example, to buy generator. Let's say the cost of a generator is 10,000 or 100,000 leons. That's the cost of the generator. Then therefore the government decided to provide support of, let's say, 80% of the cost, which is 80,000 or 80,000 leons, right? So now when we are going to account for it under the first method, it means we are going to net the cost from the government grant, then the remaining value will be depreciated. So this is exactly what the concept is saying. You can go through my recording session so that you can have a complete explanation. But basically, what you need to know, the first option is telling us that we need to take the cost of the non-current assets. We are going to deduct. Sorry, can you please mute your mic?
Sorry, can I just ask a question relating to that?
Okay, fine.
So, are you basically saying, like, if the government gives an assistance to purchase an asset, so we then minus that government assistance expenditure from the asset to get the carrying amount, and then we depreciate the carrying amount? Is that what you're essentially saying?
Exactly.
Okay.
Exactly. Any other question?
No, that's all. Thank you.
Okay, so that's the first approach that we are going to use for capital grant. The second option is treat the grant as a deferred credit and transfer a portion to revenue each year. So offsetting the higher depreciation charge on the original cost. So basically, that's why we are looking at the conceptual framework again, the faithful presentation of the financial information. So now, if we are going to use option one, basically we are going to show a less value for depreciation and a less value for the asset in the financial statement, because we are going to offset the whole government grant amount received against the cost of the assets. But if we are going to use the option two, the deferred credit approach, it means on annual basis, we are going to calculate a portion that we are going to show as revenue in the financial statement, as well as the higher depreciation that we are going to charge on the original cost of the assets, not the net cost of the assets against the government grant. So I'm going to refer you back because based on my recording session, I think I solved question relating to the treatment of capital grants. So now let's look at the treatment of capital grants. Grant for purchase of non-current assets should be recognized over the expected useful life of the related asset. IAS20 permits two treatments. Both are equally acceptable and capable of giving the fair presentation, whichever method you decided to use. Now let's look at the second method. Recognize the grant initially as a deferred income and transfer a portion to the revenue each year, so offsetting the higher depreciation charge on the original cost. So basically, this is just a detailed explanation. We don't need to worry about it. And let me go further. So now, in a situation of repayment of government grant, so when we are talking about repayment of government grant, repayment might occur if any of the conditions, after the recognition of government grant, then let's assume the conditions as per the agreement between government and the company did not meet. So automatically, we need to repay that particular government grant. So this is the condition for the repayment of government grants. In some cases, grants may need to be repaid if the conditions of the grant are breached. If there's any breach of the condition, then the company needs to repay the government grant back to the government. If there's an obligation to repay the grant and the repayment is probable, then it should be provided for in accordance with IAS37. So we are going to account for it as provision according to IAS37. When we are going to look at IAS37, we are going to cover it, but it's simple. We just need to create a provision so that we can offset the particular repayment of the government grant. So basically for IAS20, we don't have anything much to say. So before moving forward to investment property, IAS40, any question relating to government grant? Because after IAS40, we are going to solve, we as a team, we are going to solve past questions unanimously. We are going to discuss the questions. We are going to discuss how we can attack it. We are going to discuss the answers. And also we can use it between the time frame, 1.8 minutes per each question. So we are going to practice as if we are in the examination hall. So if there is no question, we are going to move forward to IS40, which is the investment property. So basically, when you are talking about investment properties, any property held for capital appreciation or for rental purpose, any other property with exception to these two conditions, so these two criteria, we are not going to account for it as investment property. Investment property should be for rental purpose or for capital appreciation. When we are talking about rental purpose, we all know, if you own a building, you own an house, then someone utilize that particular facility, then the person will pay rent. So that particular building will be classified as investment property because the building is the property is earning a rental income. Then for capital appreciation, for example, if a company bought a property, but for the present condition, there is no use for that particular building or land, whichever it might be. But by default, the building or the land will appreciate its value. The fair value will increase. So that increase in fair value, because of the increase in fair value, you can classify that particular property to be an investment property. So now, um, we are going to look at the measurement of investment property. Initial measurement, investment property should be initially measured at cost, which is clear. We need to look at the purchase cost and all directly related costs of bringing or installing the asset, whichever the situation might be. For subsequent measurement, IAS40 then gives a choice of subsequent measurement between the following. You can either use the cost model. Under the cost model, the asset should be measured or should be accounted for in line with the cost model laid out in IAS16. The cost minus depreciation or any impairment. For the fair value, once the model is chosen, it's a must to use for all investment property. So what they are saying, if we have decided to move from the cost model to the fair value model, all investment property should be accounted for using the fair value model. So now we are going to look at the condition, key concepts you need to know about fair value. Under the fair value model, key concepts you need to know under the fair value model. Under the fair value model, the asset is revalued to fair value at each year end. First concept, on annual basis, we need to revalue the assets. If we are going to um, measure the assets using the fair value model, then the first condition, on annual basis, we need to revalue the assets with fair value. First important condition. Thereafter, the gain or loss is shown directly in the statement of profit or loss, not other comprehensive income. Third condition, no depreciation is charged on the asset. So now I'm going to ask this question. Why are we going to recognize the gain especially the gain? Because I'm not talking about the loss. The loss, it is directly in line with the prudence concept. But why are we going to recognize the gain in the statement of profit and loss rather than the statement of comprehensive income? Because if we are going to look at the revaluation of IAS16, as already covered a few minutes ago, for the revaluation of IAS16, the property, plant, and equipment, the gain on revaluation should be taken to the other comprehensive income. For the gain, why is the loss? We are going to treat it as in the statement of profit and loss. But when we are talking about the fair value model under the investment property, the gain or loss should be taken directly to the profit and loss. So, what exactly is the reason? Why are we going to account for the gain on the fair value as per IAS16 in other comprehensive income, then the same gain on fair value for investment property in the statement of profit and loss? Who can tell me the reason? Are you guys with me? Hello, guys.
Yeah. Could it be because the whole point of IS40 is you're having a property or land for capital appreciation? Is that the reason why you take it directly?
Yes, that's one of the reasons. So, what about the one for the rental? So, anyone want to try? Okay, so it's fine. So, the reason is because of the capital appreciation, you know. So, also another point, no depreciation is charged on the asset. Very important point you need to know, because when question will be tested and the examination, for example, you might be tempted to to calculate the depreciation for the investment property. Depreciation figure will be part of the options, the the option A, B, or C. But you need to know that when you're going to measure the asset under the fair value model, the investment property, no depreciation is charged on the asset. Why are we not going to charge depreciation? It's because on annual basis, we are going to revalue the assets to its fair value. And also, the gain or loss will be taken directly to the statement of profit and loss. So therefore, there is no need to further depreciate the assets. So this is one condition that we are not going to depreciate assets when we are going to measure the asset under the fair value model for investment property. Fair value model is normally established by reference to the current price on an active market. Basically, for financial reporting level, we don't need to worry about fair value. IFRS 13, it will be given in the examination. Nothing to worry about fair value. So basically, we are going to look at the linkages between very important IAS 40, which is investment property, and IAS16, because some company might, own an investment property, then thereafter they decided to use it on day-to-day operational activities of the business. So automatically, we need to transfer that investment property to property, plant, and equipment. So how are we going to transfer from investment property to property, plant, and equipment is what we are going to look at in this particular session. Also, if a property is being used in the business want to stop the utilization of that property and want to classify that property as investment property, how are we going to shift? How are we going to move from IAS 16 to IAS 14? So when asset is transferred from property, plant, and equipment to investment property, which is IAS 16 to IAS 14, um, the asset must be first revalued by IAS 16. We need to know the carrying value of the asset before the evaluation, before the transfer to IAS 14, before the date of transfer to IAS 14. Very important concept. We need to know the carrying value of the asset before the transfer date. Why? We need to know the carrying value because we need to ensure if the asset is carried at cost, we need to remove all depreciation or impairment before we are going to transfer the asset as investment property. Or if the asset is carried at fair as evaluation model, we need to revalue the asset first to know the current value of the asset. Then any gain or loss should be taken to OCI or the profit and loss account. First condition that you need to know. For the fair value. Then for the when asset is transferred from investment property to property, plant, and equipment under the fair value model, if we are going to transfer the asset from investment property to IAS 16, it means we need to apply the IAS 40 principle before we are going to transfer. So if we are going to apply the IAS 40 principle, according to IAS 14, for asset that is carried at fair value, we need to ensure that on annual basis, we do a evaluation of the asset to its fair value. Thereafter, the gain or loss should be taken to the profit and loss. Thereafter, we are not going to calculate depreciation on investment property that is carried at fair value. So when the three conditions are met, the fair value of the assets before the transfer is what we are going to transfer as IAS 16. So basically, the key thing you need to know, if the property is carried at fair value, then the property is shown as property, plant, and equipment, and we want to transfer that property to investment property, we need to account for the property under IAS 16 in detail before we are going to transfer the carrying value or the fair value of the assets to the investment property. Alternatively, if the asset is being carried at IAS 40 investment property and we want to transfer that asset to IAS 16, if the asset is at fair value, we need to ensure we revalue the assets before the transfer. We need to take the gain or loss on the fair value to OCI, to profit and loss. Then also, we don't need to calculate depreciation on investment property. Then we need to transfer that property to IAS 16. That's for the fair value. So what about the cost model? It's the same. Nothing to worry about the cost model. When an asset is transferred from property, plant, and equipment to investment property IAS 16 to IAS 40, we are going to do our normal calculation under IAS 16. The cost, less accumulated depreciation, less any impairment. The remaining value, which is the carrying value, we are going to transfer it to investment property. Simple. When asset is transferred from investment property to property, plant, and equipment, IAS 40 to IAS 16, under the cost model, we need to do the same thing. Looking at the cost of the investment property, we need to deduct any depreciation, and also we need to check for any impairment. Then the remaining value, we are going to transfer it to IAS 16. So basically, these are the linkages between IAS 16 and that of investment property IAS 40. So for this example, you can go through my, for example, two, you can go through my live online session. And also for these kids questions, I'm going to leave it for now. When we are going to solve the past questions, we are going to look at the various questions. So basically, for the revision of the key concept, we are going to stop here, and we are going to move on solving questions relating to IAS 16, relating to IAS 40, and relating to IAS 20. Any question before going further to the kits? Any questions? Any question? Hello, guys. Any question?
No, sir, we are still here. Let's continue.
Okay, just give me a minute. Let me take my calculator. Oh boy. Oh boy. Oh boy. Let me calculate over data. Okay. So any question? Hello, guys. Any question? Or let's proceed to the kits. Any question? Hello? Hello?
Yes, let's continue.
Are you seeing my screen right?
Yes, sir.
Yes.
So we are going to look for questions relating to what we have covered so far. This is Kaplan kit. So very good. First question. Are you with me? Question one. Hello? Are you guys with
Share
me?
the
was
kit.
calling us.
Yes, sir. We
Yeah.
are with you, sir.
Okay. So we are going to solve the questions together.
Which page? From the kit, which page?
Page 23. Are you seeing my screen right?
Yes, we can.
Yes, yes, yes.
So let's focus on the screen, then we can solve it together. So question one. IAS 16, the property, plant, and equipment requires an asset to be measured at cost on its original recognition in the financial statement. EW used its own staff, assisted by contractors when required, to construct a new warehouse for its own use. Identify whether the cost listed below should be capitalized or expensed. So under the subsequent measurement, under the capitalized expenditure, as I explained, we need to know which cost are we going to capitalize or which cost are we going to expense. Very important concept you need to know. So now let's look at the option and which cost are we going to capitalize and which cost are we going to expense. First option, clearance of sites prior to commencement of construction. Second, professional survey of fees for managing the construction work. EU owned staff wages for time spent working on construction. Hello?
Yeah, the screen that I'm seeing is not showing anything.
What about the others?
The
For me,
screen
I'm
is
seeing
okay.
it.
Your screen is okay.
What about the others? Are you seeing?
Yes, sir, your
Yes.
screen is okay.
Yes.
So now we can the fourth option, a proportion of EU administration costs based on staff time spent. So for the first option, the clearance of sites prior to commencement of construction, are we going to capitalize it or are we going to expense it based on the concept of IAS16?
Capitalize it.
Capitalize it.
So why are we going to capitalize it? Why? And what
Because
will
they
be the
had to
reason?
prepare the site. So they had to spend money to get the site ready for the plant or construction, whatever it was.
Okay, so basically it means without the site preparation, the construction will not take place.
Yeah, the cost was incurred purposely for
Fine, fine,
the
fine,
asset.
fine, fine. Very good. Very good. Any other reason different from the two mentioned? Okay, it's fine. So the first option we are going to capitalize. So in the examination, you are going to tick capitalize. The box will be activated that you can click, then the option will be shown as capitalize rather than expense. Second option, professional survey of fees for managing the construction work. Are we going to capitalize it or are we going to expense it? And what is the reason?
Capitalize it.
So any other different opinion? So why are we going to capitalize it?
It's because without a surveyor, you wouldn't know how, where to plan, how to go about construction. You need a surveyor to guide you, kind of thing, right?
Very good. Any other different option? So the next point, EU own staff wages for time spent working on construction. Are you going to capitalize it or are you going to expense it?
Capitalize it.
Why are you going to capitalize it or why are we going to expense it?
Totally
Uh,
clear.
we're gonna
You
capitalize it
capitalize it.
because
Okay. What about the final point? A proportion of EU administration cost based on staff time spent. Are you going to capitalize it or are you
That
going to
one is
expense
an
it?
expense.
So why? What,
An
what is the
expense
what is the reason?
does not directly relate to the assets in connection with the assets. They are administrative costs.
Aha, that's the reason because it's administrative cost. So now, what do we mean by capitalize and expense?
capitalization basically means that you show it on your balance sheet as non-current asset,
Okay, so what about
and
expense?
expenses go straight to your P&L when it was incurred.
Okay, so capitalization means we need to include that cost as part of the cost of the asset, which is going to
Most of the
be in the
assets.
statement of financial position. Very good. So we move to another question. Very good, fine. Calculation. Let's look at the requirement first. For any objective test question, you need to read the requirement. Reading the requirement will guide you on which accounting standard that is tested. The requirement stated that what is the total charge to the statement of profit or loss in respect of decommissioning for the year ended 30th June 20x5. Very important. We need to note the date down. We are going to calculate the total charge to the statement of profit or loss. So when we are talking about total charge, it can be the unwinding, because we are talking about profit or loss, not the statement of financial position. So it's possible the unwinding, or it's possible the depreciation. These are the two factors that we are going to consider. What is the total charge for the statement of profit or loss in the respect of the decommissioning for the year ended 30th June 2026? This concept is according to IAS 16, the dismantle cost, the decommissioning, or the restoration cost. So now this is the requirement. So now we need to read the question carefully. On 1st June 20x4, on 1st June 20x4, experimenter opened a chemical processing reprocessing plant. The plant was due to be active for 5 years until 30th of June 20x9, for 5 good years. So from the 1st of July 20x4 to the 30th of June 20x5 is 1 year, 20x5 to 20x6 2 years, to 20x9, so for good 5 years. When it will be decommissioned, so at year 5, we are going to decommission that particular plant, that reprocessing plant. Now, at 1st July 20x4, the cost of the decommission of the plant we are estimated to be 4 million in 5 years' time. So it means in 5 years' time, the cost will be 4 million. So this 4 million is a future value. So we need to discount it to present value as of today value. The experimenter considers that a discount rate of 12% is appropriate for the calculation of the present value, and the discount rate factor of 12% for 5 years is 0.567. So basically, the aspect of calculating the discount factor is already solved in the question. The question gives the discount factor we need to use. So now, I want everyone to solve this question. I'm going to give a minute before I'm going to solve it. A minute. Let's come up with um, options within the question, so that we can have a feeling of the actual situation. So the question is very, very simple. Let me guide you. The first thing you need to do, you need to note the date down, and we need to calculate the total charges as at the 30th of June 20x5 for 1 year period. So basically, we need to discount the future value of 4 million to present value. It means we are going to multiply the 4 million by the 0.568. That will give us the present value as of today. And that value, we are going to debit the asset and we are going to credit the liability. Simple. Then thereafter, what we need to do, we need to calculate um, depreciation on the asset, and also we need to calculate the unwinding on the provision. Two separate calculations. We are going to do it for the depreciation for the asset that we have debited, and also the provision that we have credited. We need to unwind it on annual basis. So now you can solve and give me the answer. Then thereafter we can solve it together. So basically, what is the cost? Let's do it bit by bit, right? What is the present value as of today of the 4 million? What is the present value?
2268. 2268.
So the present value is what? 2268. Any different option?
2268.
And how did you get the 2268?
Multiply the 4 million by 0.56.
Okay, okay. Yes. So basically, we are going to debit the 2 point, the 2268, eh? Hello? Are you guys with me?
Yes.
Yes, yes.
So we are going to debit
2268.
2268, and we are going to credit 2268 assets and provision. So now, what will be the unwinding cost, as well as what will be the depreciation?
It'll be
What will be the
12%.
depreciation?
So the depreciation would be 2268 divided by 5, the useful life,
Okay.
which gets you 453,600.
Fine, 453,600. So now, if you might be tempted, 453,600 is part of the first option, which is option A. But that is not the answer, because the question stated that what is the total charge, not the depreciation. Very important. You need to read the requirements carefully. If the question stated that what is the depreciation charge to the statement of profit and loss, then the answer will be 453,600, right? Based on your calculation.
Yes.
Yeah, but the question stated that what is the total charge to the statement of profit and loss, not the depreciation in isolation, not the unwinding in isolation. They need to join both the unwinding and the depreciation. So now we need to calculate the unwinding, the provision aspect that we are going to show in the statement of profit and loss. So we can calculate the provision aspect
The
from that.
unwinding.
So the unwinding is 272,160.
How did you calculate the unwinding?
So it's the 2268, and then you multiply by 12%, which is the discount factor, the cost of, the discount rate
Okay, very good. Okay. Okay. So what is the answer for the unwinding?
is 725. Oh, sorry, the unwinding is 272,160.
So okay. So now the unwinding plus the depreciation, what will be the total answer?
725,760.
725,760. So the correct option is B. Correct option is B, right?
Yes.
So now let me dive further on this particular question. Let's assume the requirement stated that what is the total charge of this to the statement of profit or loss in respect to the decommission for the year ended 30th June 20x6, not 5 again. 20x6. The only difference between what I'm asking now and this particular question. So what will be the difference and what will be the answer? Can someone please help me? Only the date that is changed from 30th of
Come
June
again, please.
20x5 to 30th of June 20x6. The second year. What are you going to recognize as depreciation and what are you going to recognize as unwinding cost for 20x6, the second year? Anyone can help?
For the unwinding is 304.8 for 20x6.
How do you calculate it?
You take
How do you calculate it?
the dismantling cost, the commission and cost. You add and multiply it by 12%.
Very good. So it means when you want to calculate, when you want to calculate the decommission in cost, the unwinding cost, sorry, the expense portion, you need to multiply it against the closing liability, against the closing provision. So in other words, at year one, the 453,600, we are going to debit expense and we are going to credit provision. We are going to increase the provision. So when you are going to multiply the 12%, we are going to multiply it on the current provision figure, not the old one again. Are you with me? So we are going to multiply the 12%
Yes.
on the closing liabilities, not the opening liability anymore. So the 12% for year two will be multiplied against the liability figure, which is 2268, right?
Yes.
Plus the 453,600. 2268 plus 453,600 multiplied by 12% will be the second year unwinding cost. The depreciation will not change because it's a straight line method. The depreciation will remain the same. So very good. So we can move to question 3. Let's see if it relates to okay. So question 3 is saying what is the gain on disposal of property, plant, and equipment that will be reported in the statement of profit or loss? Are you guys with me? And the question
Yes,
stated
sir.
that
Yes, sir.
what is the gain on disposal of property that will be reported in the statement of profit or loss for the year ended 30th June? You need to read the question. You need to read the requirement 2 times. What is the gain? The question is asked for gain. What is the gain on disposal of property that will be reported in the statement of profit or loss for the year ended 30th June 20x7? Gain and 30th June 20x7. Key point. Now we go to the question. An entity purchased property for 6 million on 1st July 20x3. On 1st July 20x3. Are you guys with me? Hope we are all on the same page. What about the others? Please,
Yes.
I need your feedback. I need your comments. Are we all together?
Yes.
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 If you don't understand anything, don't feel ashamed. Don't left out. You need to um come out clean and say yourself so we can able to explain. We are here to learn. That's why I'm doing the session interactive. I don't want to be solving questions without the involvement of you because the session will be more beneficial for you guys. So let's contribute. Let's ask questions. What is the reason why I'm going to do it this way? We need to ask questions. This is the kit question. It is very important. We need to look at the real time examination questions. You can see what I've covered so far. When it comes to pure application, it needs to be different. You need to get the confidence and the maturity to be able to attack past questions. An entity purchased property for 6 million on 1st July 20x3. Note the date on 1st July 20x3. And the reporting date based on the requirement is 30th of June 20x7. So from 20x3 to 20x7, it means there has been a lot of depreciation because of it's almost a 4-year period. 1st July to 30th of June 20x4 is 1 year, 20x5 2 years, 20x6 3 years, 20x7 4 years. The land element of the purchase was 1 million. The land element is 1 million, so it means the remaining is for building. Are you guys with me?
Yeah.
Fine. The land, land is not depreciated. We are not going to depreciate land. The expected life of the building was 50 years. And its residual value is nil. So when we are going to calculate depreciation on straight line method, we are going to depreciate the asset over the building over its 50 years. On 30th of June 20x5, on 30th of June 20x5. So we have moved from 1st of July 20x3 to 30th of June 20x5. So it means before the 30th of June 20x5, we need to know the carrying value of the land as well as the building. Very important. Are you guys with me? I'm trying to
Yes.
I'm trying to split.
Yes, sir. We are here.
Fine. I'm trying to split the concept so that we
Yes.
can
Yes.
we can do
We
it
are with
better for
you.
you to understand. The
Yes. It's
expected
only
life.
that we are meeting our speakers, so
Okay,
that's why
okay,
the response is late.
okay. It's fine. It's fine. It's fine. So we continue. Um, on 30th of June 20x5, I'm going to repeat that point again. From the 1st of July 20x3 to the 30th of June 20x5, there has been some amount of changes in the carrying value of the asset, especially the building, because of the depreciation. So what we need to do, we need to calculate the carrying value of the asset before the 30th of June 20x5. We need to know the carrying value of the asset. On 30th of June 20x5, property was revalued to 7 million. So we need to know the carrying value of the asset before we are going to consider the revalued amount, whether there is a gain or loss on the valuation. And from this question, we don't need to know whether it's a gain or loss because the question asks us about gain on disposal, not gain on revaluation. Of which the land element is 1.24, the land element based on the revalued amount, and the building is 5.76, which is fine. On 30th of June 20x7, the properties was sold for 6.8 million. So now, before the disposal, 30th of June 20x7, we need to know the carrying value of the asset before the disposal. So we are going to compare the carrying value of the asset before disposal and that of the proceeds that we receive from the disposal of the asset, which is 6.8 million. So now we are going to solve the question as team. Everyone take out a piece of paper and pen. We are going to solve the question. I'm going to say it, then you can solve it on your own. I want you to do the solution. I don't want to write again. Are you with me? I want everyone to involve so that we can
It's
have
okay.
a taste of the
Yes,
examination.
sir.
So now let's
Yes.
take off the piece of paper. So we are going to split it into two. We are going to split it for land and building, then total column. Land, building, and total column. Or let me solve. Which option do you prefer? Let me solve or let's do it together. Let's do it together, right? Are we all together?
Yes.
So now we are going to split between land, building, and total. Let's do it this way. So now, first transaction on 1st July 20x3, the value of the land is 1 million. On the land, put 1 million. And the value of the building is the difference between the land and the 6 million, which is 5 million. Are we together?
Yes, sir.
Okay, I want also keep track of the solution. That's why. So now, are you with me? Land, building,
Yes.
total, right? On
Yeah.
1st July 20x3, the value of the land based on the question is 1 million, right?
1 million.
And
Yeah.
Yeah.
the value of the building is the difference between the total value of the property and the 1 million, which is 5 million.
5 million. Yes.
The total is 6 million.
Yes.
Very clear. The land element is this. The expected life of the building was 50 years, and its actual value is 0. On 30th of June 20x5, we need to calculate the depreciation, we need to calculate the carrying value of the assets before the 30th of June 20x5, which is very important, right?
Yes.
So now we are going to
Yes.
calculate depreciation. How many years depreciation are we going to calculate? From
2 years.
2 years depreciation. The 30th of June 20x4 and the 30th of June 20x5. So we need to calculate 2 years depreciation. So basically, we are going to depreciate the assets. It will be the 5 million because we are going to depreciate building. We're not going to do anything with the land value because land is not depreciated.
Yeah.
5 million divide by the useful life of the building, which is 50 years, multiply by 2 years because we need a 2 years depreciation. Are we together?
Yes.
Very good. So what will be the answer? For land is 0 and
4,800,000.
what will be the answer for the depreciation?
Oh, 200,000.
So let 200,000, let's put it in million. Let's just say
Uh,
5.
it's, it's 200.
No, let's put it in million. Let's say 5 divided by 50 multiplied by 2. I want to indent the zero. I don't want to use so many zeros. 5 divided by 50 multiplied by 2 years. 5 divided by 50 multiplied by 2. The answer is 0.2 million.
0.2. Yes.
So we are going to deduct it because it's the depreciation. Therefore, the total depreciation will be 0.2, right? 0.2 million.
Yes.
Very clear. So now the carrying value at 30th of June 20x5 will be what? For land will be 1
1
million.
million.
For the building will be 5 million minus 0.2, which is 4.8 million. And the total will be 6 minus 0.2 will be 5.8. 5.8, right?
Yes.
Very good. So this is the value of the asset before the revaluation. This is the value of the asset before the evaluation. So now we need to look at the question. On 30th of June, the property was revalued to 7 million. So we need to look at the evaluation again. So at 30th of June, the revalued property. The property has revalued to the building is 1.24. Are you with me?
Yes.
The land, sorry.
Yes, yes.
And the building is 5.76. Therefore, the total is 7 million.
Yes.
So now we are going to calculate the gain or loss on the revaluation. For land, there is a gain of 0.24. Are we together?
Yes.
For building, there is a gain 5.76 minus 4.8. Answer, please.
0.96.
0.96. And 7 minus 5.8 is 1.2.
2. Yeah.
1.2. So now, don't forget the question is about gain or loss on revaluation, not on disposal, not gain on revaluation. So that anything to do with the gain on revaluation. So further the requirement, or further the question, sorry. On 30th of June, the property was sold for sorry, the question did not complete. The property was sold for 6.8 million, right? 30th of June. So now we need to determine the carrying value of the asset before the disposal. On 30th of June, we need to determine the carrying value. So carrying value at 30th of June 20x7, right? So now for the date of evaluation, which is 30th of June 20x5 to 30th of June 20x7 is how many years?
2 years.
2 years.
2 years.
So we need to calculate additional 2 years depreciation on which value? Very important concept. On which value are we going to calculate this current year depreciation?
On the revaluation amount.
Very good. We are going to calculate it on the revaluation amount, on the revalued amount, not on that historic cost anymore. We are going to use now the revalued amount. So basically, and depreciation on revalued amount. So the depreciation will be the revalued amount. The building, we are not going to depreciate the building. Sorry, the land, we are going to depreciate the building, right? For building, what will be what is the revalued amount? What is the
It
revalued
is
amount? I want to have your feedback. What is the revalued amount for building?
5.76.
5.76. Divided by what? What are we going to divide to get our depreciation?
48, is it? 48 years?
48 years,
Why are
yes,
we going to
because
use
we've
48
already
instead of
consumed
50?
We've taken
because
2 years already.
yeah, we've
Very good.
consumed 2 years before the evaluation.
Very good. Very good. Very good. Very good. So what if our previous year depreciation is 2 years, 6 months? What are we going to do to calculate the current depreciation we are going to calculate now?
3 years, 6 months.
6 months, yes.
2.6, is it? 2.5.
Very good, 2.5. Why are we not going to use 2.6? Because 2 years, 6 months is 2.5 years. Because we are
Yeah.
operating, the year is 12 months. So 6 of it is half. So we are going to use 2.5. If you use 2.6, automatically you are going to miss the answer. Or you can convert it to month. It's very simple. Convert it to month. The 50 years multiplied by 12, you have the month, then you're going to depreciate it based on month. Whichever option. So you just need to be mindful of what you are going to do. Be consistent. If you're going to use year, you need to use year. If you're going to use the month, you need to use month. Are we together? So now we are going to
Yes.
use
Yes,
48 years. How many years are we going to how many years depreciation are we going to calculate? 3 years. Why 2 years? From 30th of June 20x5 to 30th of June 20x6 is 1 year. From the 1st of July 20x6 to 30th of June 20x7 is 2 years. So we are going to calculate 2 years depreciation for building. So for land is 0, right? For building, what will be the amount? What will be the amount for building depreciation?
240. No, 2.4.
2.4?
Yeah.
2.4 is too much. So 5.76 divided by 48. 5.76 divided by 48.
0.24.
Okay, 0.24. Okay, sorry, 0.24. Okay, I get it twisted. 0.24. So the total depreciation for this year will be 0.24 again.
0.24.
So let's calculate the carrying value at 30th of June 20x7. Right? So for land, the amount will be 1.24, no depreciation, no depreciation. For building, the amount will be what? 5.76 minus 0.24.
5520. 5.
5.520, right?
5.5.
So what about the total value? 7 minus 0.24 will give us 3.6, 3.6, 3.36, right? Or 3.76 or 76.
No, 76. Yeah.
76. So basically, this is the value of the assets before the disposal. This 6.76. So now this is the carry value before disposal. So we need to compare the carry value before the disposal and the disposal value. So proceeds, disposal value, bracket proceeds. The proceeds is what? 6 point what?
8.
6.8 is the proceeds. 80. So now we are going to compare the difference between we are going to compare the proceeds and the carrying value. The proceeds is greater than the carrying value, so there is a gain on disposal. Gain on disposal. Are you with me? It means the value of the asset is 6.7. Then we sold it for 6.8. So there is a gain. There is a gain on disposal.
0.4. Yeah.
0.4. So basically, 0.4 should be the correct answer among the options. 0.4.
Yeah.
So at which option? 40. So 0.4 multiplied by million, so it will give us a gain of 40,000. Are we together?
Yes.
Yes.
So, any question? So, you see how technically year life examination is. That's why your concept and your principles should be updated so that you can be on a better position to solve. We move from various period, how to calculate depreciation, how to reduce the years, how to revalue, just to get the gain on disposal.
Mr. Titi? Hello?
Yes, sir.
Hello?
Yes, I'm getting you. I'm
Mr.
getting you.
Titi?
You can make your point. Hello?
Okay. Oh, we'll chat.
No, I'm getting you. You can speak. Hello? Hello?
We'll chat.
Or you can drop your message on the WhatsApp. Drop your message on the WhatsApp group.
Yeah, for my own calculation, I have a loss of 200.
Okay, you have a loss of
Okay.
200. So, how did you calculate?
Yes.
So, what is your current value that you compared with the 6.8? What is the current value as at the 30th of June 2027? What is your current value as at 30th of June 2027?
Hello?
Yeah, I'm getting you.
20x 7.
Yes. What is your current
My
value?
carrying value is 6760.
6.7.
6760.
Yeah, 6.7.
Yeah.
You mean
6.
6760.
6.760? Can you snap your solution? Send it in the WhatsApp group. Hello? Snap your solution, send it in the WhatsApp
Okay,
group,
let me
please.
forward it in the.
Yes.
Okay.
Any other question, any other suggestion, any other option in terms of your solution?
Um,
Okay. Yes, I'm currently looking at it. Okay. Yes, from your solution, evaluation, notification is one. Yes, where you go wrong? Are you getting me? I've seen your mistake. Are you with me?
Hello?
Yeah, are you with me?
Yes, yes.
So now you can look at your calculation before the evaluation. You have 5.8 carrying value before the evaluation, which is fine. And the valued amount is
Mm-hmm.
7 million, of which 1.24 is land and 5.76 is building it, which is fine. Now, the area of error is in depreciation. The depreciation is over 48 years, which is fine, but we are going to calculate depreciation for 2 years, not 1 year, because the evaluation takes
Yeah,
place.
I multiplied by 2. If you look at down, you will see 120 multiplied by 2.
Okay, so now take your calculator. 5.76, right? Divided by 48. will give us 0.12, multiply by 2 years will give us 0.24, which is fine. Yes, I've seen it. You get it right? Then thereafter, your current value is 7 million minus 240. No, the 7 million is including the depreciation.
It will give
But
us 240.
yeah, but you have 6,760,000. So now you need to compare the 6,760 with the disposal proceeds, not the
Hello?
7 million again. Hello? I've seen your error. What you did,
Yeah.
to calculate the gain on disposal, you compare the revalued amount of 7 million instead of using the depreciated revalued amount of 6.76. That's where the difference lies. You should use the depreciated revalued value, which is 6.7 instead of 7 million. The 7 million is the revalued amount, which is the value of the asset as at the 30th of June 20x5. But the value of the asset that you should compare is the value as of 30th of June 20x7, not 20x5. So now if you go back to your question, to your solution, you need to compare 6.76 and 6.80.
Okay.
Are you fine now?
Yes.
So now you need to compare like with like. You need to compare the carrying value as at the 30th of June with the proceeds at the 30th of June. That's why we are doing the evaluation. Any other question? Any other suggestion? If you have doubts, you can let me know so we can eye on it now. We can eye on it now. Any doubt, any question, any recommendation, or let's move. So basically, I think we need to have this session on, if not daily, but we need to have it one in, one out, so we can cover a lot of things. But can you imagine? We almost spend from 7:40 to 9:18. We are going to spend now close to 2 hours. We did not do much of the objective test question. So I'm going to recommend to all of us that we need to do this on daily basis so that we can cover more. I don't know what you can say about that.
I'm happy with that.
Because the examination is just around the corner. It's 4 weeks. So you need to sacrifice to ensure that we spend the 4 weeks properly so you can able to obtain the pass mark. We forget about financial reporting. We move to another paper. So tomorrow back we are going to get a live online revision class. We are going to continue where we are going to stop today. So now let's look at question 4. What is the deferred income liability? So basically, this is talking about IAS what? IAS what? This is talking about IAS what?
IS government grant. Which one's that? IS20?
Very good, government
20.
grant. So now we are going to use government grant approach to solve this question. The question is asked about the income liability at 30th of June 2023. I'm emphasizing on the date. You want to say something?
23. IS40.
IS40.
No, I'm okay. I'm okay. Let's
Okay.
proceed.
Okay. I'm emphasizing on the requirement. Understanding the requirement is 50% part of solving the question correctly. What is the deferred income liability balance at 30th of June 2023? A manufacturing entity received a grant of 1 million towards the purchase of a machine on 1st January 2023. Can you imagine on 1st January 2023, the company received a grant to purchase a machine? So which type of grant is this?
It's capital grant.
It's capital grant. So we are going to account for it under the capital method. And based on the question, we need to use the deferred income approach because that's what is stated from the question. The grant will be repayable if the entity sells the assets within 4 years, which it does not intend to do. So it means there is no exception in terms of the breach of the government grant. The asset has a useful life for 5 years. So now we need to calculate a deferred income liability as at 30th of June 20x3. From 1st of January 20x3 to 30th of June 20x3 is how many period?
6 months.
So basically, we need to account for 6 months, and the remaining 4 years, 6 months, we need to show it differently. So now, what will be the answer to this particular question? How are we going to solve this? We need to do it together.
So it'll be 1 million divided by 5,
Why divided by 5?
because it's 5 years. The useful life is 5 years, and
Okay.
it's a capital grant, so it's a purchase of an asset. So you treat it as the same as the asset,
Okay.
the
Okay.
useful life of the asset, and then you multiply that by 6/12,
Why
which will
are we
get you
multiplied by?
the
Why are we going to multiply it by 6/12?
because the machine was purchased on the 1st of January 2003, but they're asking for the deferred income liability balance at the 30th of June 2003.
Okay. Yes. So what next?
So that'll get you the amount that would have been released or depreciated, and then you just take that off the million to get the balance then.
So what will be the balance?
900,000.
Any other alternative solution? Any other alternative solution, or anyone has solved and you have different answer to what Mr. 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 what?
I think
Anyone with
it's
different
okay.
answer?
900. No, no, no.
Oh,
900.
Yeah.
Okay, so let's assume the question is, what is the deferred income, not liability. What is the deferred income? What will be the answer? Are you with me? If the question stated that, what will be the deferred income, not liability, I'm talking about deferred income, what will be the answer? Are you guys with me?
The deferred income, is it not 100?
Exactly, 100. Because that's the actual amount you are going to show as deferred income within the period. The liability is the
Yeah,
outstanding deferred
the
income that we
outstanding.
need to spread, that we need to recognize in the future. So now, when I'm going to whenever you are solving objective question, you need to look at the
Okay.
requirement and try to twist it a lot of ways so you can able to word in the scope, and you need it will give you more focus on key areas. Are you with me?
Mhm.
So now look
Yes.
at the
Yes.
dynamics. Just because of a change from deferred income and deferred income liability, automatically the answer is different. So in normal situation, there will be 100. Let's assume there is we have option A, B, and C. There will be 100. There will be 900. There will be 2,000. There will be 200. So if you did not understand the requirement, for example, instead of deferred income liability of 900, you decided to calculate the deferred income. Automatically, you have lost 2 marks just because of not that you did not understand the concept, but just because of you fail to understand the requirements. Very important. So you need to understand the requirements, and also you need to twist the question so that you can able to have the best out of the question. So basically, let's agree at what time we are going to stop the session. I don't want to disturb anyone. At what time we are going to, because we are going to continue back tomorrow so that we can complete all of the objective test questions for 16, 20, and 40. Let's round it up to 2 hours. 9:40, right?
Yeah, that's fine.
Yeah. So tomorrow back we can continue from 7:30. Then we can push it. So basically, we can look at question 5 on 1st January 20x1. Let's look at the requirements first. What should be recorded in the financial statement on 1st January 20x2? Financial statement. What should be recorded in the financial statement? So when we're talking about financial statement, it can be statement of profit or loss. It can be statement of financial position. It can be cash flow statement. It can be equity, statement of changes equity. It can be notes to account. So it can be any of the above. So now we need to
It could
tell
be any of them.
ourselves what should be recorded in the statement of financial position on 1st January 20x2. That's the requirement date. On 1st January 20x1, S receives 1 million. Are you with me?
Yes.
Yes.
X receive 1 million from the local government on the condition that they employ at least 100 staff each year for the next 4 years. So this is the condition. Due to an economic downturn, a and reduced consumer demand on 1st January 20x2, that's 1 year after the government grant. Let's understand the question, right?
Yes.
Due to an economic downturn and reduced consumer demand on 1st January 20x2, 1 year after the government grant, S no longer need to employ any more staff, and the condition of the grant required full repayment. So now let's understand the question. On 1st January, 1 year after, the company did not able to meet the condition as per the government grant, so they need to repay the government grant. But already they have accounted for the government grant in the first year, because at the first year the conditions are met, but in the
Yeah.
second year the condition did not meet. So now we need to consider the repayment of the government grant according to the IAS27. So now what will be the answer to this particular question?
So
Option A.
you would reduce the deferred income by 750,
How did you
and then
how
you
did
would
how, how,
recognize.
how did we get the 750 first?
So basically, because we've only taken 1 year, we've recognized 1 year. So if you think about it, it's 1 million divided by the 5 years, or 4 years, sorry, 4 years, you get 250,000, yeah? Which you would recognize that as your income, isn't it? Because there's a capital, is this to do with capital? Yeah, capital grant. So the remaining balance you would have is 750 that you would release over the years. So now, because we've got to pay that 750 back, so you're going to reduce your deferred income, but then because you've already recognized the 250 as your income, you're going to now have to give that back. So that's going to be a loss, which then gives you the million back.
Okay.
B is the correct.
Okay. Any other option? Any other option from the various options?
For me, I'm seeing B as the correct option because the 250 was already recognized as his thing, and the 750 is deferred. So we need to reverse the 250 again, and we reverse the 750. So option B for me is fine.
So any other different option? And the reason, let's discuss the issue together. so we can be on the same page. We can understand better. Please, guys, let's discuss the issues, please. Okay, if there is no further comments, then option B is the correct answer because the 250 will be recognized as the deferred income and the 750 will be recognized as a deferred income liability. Are we together?
Yes.
Very good. For the first year, we are going to recognize deferred income in the statement of profit and loss, and we are going to recognize deferred income liability in the statement of financial position for year one. Because the conditions as per the government grant are met at year one. But in year two, the conditions did not meet. So if the
Yes.
conditions did not meet, we need to repay the government grant back in full. So repayment of the government grant, it means we are going to reverse the accounting treatment initially done. Initially, we had recognized a deferred income gain. So now we are going to recognize a loss on a recognition, which is 250. And also, we have recognized a deferred income liability. So we need to reverse that deferred income liability of 750. So the correct answer is option B. You reduce the deferred income and recognize a loss of 250, which is very clear. Final question for today. Which of the following property owned by S will be classified as investment property? Option A property that is held, a property that has been leased to a tenant but which is no longer required and it is now being held for resale. Land
No.
purchased for investment potential. Planning permission has not been obtained from building construction of any kind. A new office building used as head office purchased specifically in order to exploit its capital gain potential. A state home, a stately home used for executive training. So what is the correct answer? The question is that which of the following properties owned by S will be classified as investment property according
It's
to
B.
AS40? B,
B.
why
Yeah.
B?
Because B is, they've purchased the land for investment potential. So that's where the key point is investment, and it's an investment property. A is relating to
Yeah,
IFRS
Commander.
5
Okay.
because IFRS 5 is about sale, isn't it? Sale of property or some,
Yeah, non-current
I think
assets made for
IFRS.
sale and discontinue
Yeah.
operation.
And then number C, letter C and D, they're all to do with IAS16 because they're using it for head office. So that's the non-current asset, right?
Very good. Any other
So
different option? Any other reason why option B is correct or option B is wrong? Are we together? Any other reason? Okay, so thank you very much. And
Oh,
to round it up, I'm encouraging everyone to be on time, 7:30 prompt. And today we wait for 10 minutes before we finally start the session. And also advising everyone to go through the lecture notes. Then thereafter we can look at the objective question. Tomorrow I will also advise someone can log in to the CB practice platform. We look at live questions in our subsequent lecture so that we can able to navigate within the CB platform.
could I ask, tomorrow when we come back, are we just going to go through the OT questions from the standards that you mentioned at the start of the class today?
Yes, I want us to complete all the standard relating to. I mean, I want us to solve all questions relating to IAS 16, 40, and 20
Okay.
before moving forward. I don't know. If you
Okay.
have different
Yeah.
option, it's fine.
No, that's absolutely fine. That works well. Thank
So
you.
I believe tomorrow, 2 hours, we can complete all question on 16. Thereafter, next tomorrow, we can look at other 3 or 4 accounting standard, whether leases,
Yeah.
whether IFRS 9, whether borrowing costs, whichever account, whether impairment, inventory, whichever account is standard, we are going to decide unanimously, we are going to agree which standard we are going to cover and how are we going to cover it. Because I want us to do this as a team. I don't want to dictate this is the way, this is the way. No. So
Good.
any
Thank you.
question? Any question? I want to round off. Any question? Any suggestion? Any recommendation? Any way of improvement?
Oh, perfect. Thank you for your help today.
Okay. So, any other? So without any other question, thank you very much for your time
Yeah.
and your efforts.
Okay.
Thank you all.
Okay.
Okay.
Thank you, sir.
Okay, boss. Bye for now.